7 years. Oh, anyway.
I'm going to have to say over 20 years.
Yeah, pushing 30.
Yes.
Good heavens. All right. Anyway, I apologize for that little bit. But anyway, thank you for having me on. I appreciate it.
Hey, no problem. And listen, we've seen gold and silver smackdowns before where they suppress both of these for one particular reason or another. And just the other day, I think it was last week, they dropped silver by 10%. Now, a lot of people say it was a glitch. A lot of people say it was a fat finger error. But it was like 8,200 contracts, which is like 40 million notional ounces of silver. When you look at this, I mean, was this, a fat finger or a glitch, or was this done on purpose?
You hit it, Dave. A lot of people say this, a lot of people say that. And the reason why is because we don't know. The CFTC could probably figure it out, right? The CME could clearly figure it out, right? They could figure out from where that order came. It looked to be right on the nose, 5,000 contracts to sell the front month September silver contract. And it hit at rather odd time. It wasn't like there's any news going on. And it was in the middle of the European night. It was in the evening here in the U.S., 7:06 Eastern time in the evening last Thursday when nobody's around, probably about the most illiquid time of the day. And so that makes you think, well, either it was done deliberately, as we've seen it, for years now, or perhaps it was just an error, something, an algo run wild. Somebody put in an order to sell 50 silver contracts, and instead they the zero got stuck and they put in 5,000. Either way, I think one of the most compelling lessons of it all was how quickly the CME came out. I mean, it was really within like 7 or 8 minutes, and said, we're not going to execute or show any trades below, I think it was $15.54. But there had been trades, like you said, it took the price down 10% in under a second. I mean, this is a globally recognized price, right? This is the price that supposedly prices physical silver, but this one paper trade changes the price in 10 seconds. And 5,000 contracts, again, that's 25 million ounces, right? And nobody has 25 million ounces to sell a physical, right? So it's all just a paper scam. But again, the most telling part of this is the CME comes out and says, oh, look, we're not going to show any fills below 1554. Well, who does that benefit? Does it benefit the regular trader that had some stink bids in there at 1450 and magically got filled, when everything got wiped out and you had this big plunge? No, it benefits that seller who accidentally put in that order or deliberately put in that order for 5,000 shares. All those sell orders that got filled down at 1450 and 1440, they got raised by $1. Isn't that slick? And so the CME showed its hand. I mean, they screwed the little guy. They screwed anybody that was buying and helped whoever was selling. And I've not seen anybody, figure that out yet. I'm the only one that seems to want to point that out in all the analysis that I've seen in the last week. And so can we use that then perhaps to discern what happened? Because again, if it was just an error, if it was a fat finger error on the seller's part, you would think the exchange would look at it and go, well, sorry, that'll teach you never to do that again. And they'd show all these fills down there at 1430. But they stepped in immediately to protect the seller. Again, which I guess to me, as someone who has called this a criminal conspiracy between the banks and the regulators and the exchange, and I've been doing that now for 7 years on this site, to me, it just fits the pattern. I wrote something yesterday, Dave, about I'd seen an article on the internet. John Butler had retweeted something from, it was right at the end of June. Some guy's written a book, again, disparaging gold, and making us all sound like we're just a bunch of maniacs. And it was right along the lines of that thing from 2 years ago about how gold's just a pet rock and why would anybody want to own it. And so I'm writing a post yesterday and I'm remembering when that pet rock article came out. And it was Friday, July the 17th, 2015, which is a similar time, to where we are now in terms of sentiment and market structure and everything else. And as I'm researching this current post I was writing, I'm remembering this period from almost exactly 2 years ago, because that article came out on Friday the 17th. And then on Sunday night, the 19th of July 2015, at almost the exact same time, an hour or two after the Globex reopened and it's a light Sunday trade, all of a sudden there was this massive flash crash in gold. Last week, the silver market was, I guess, locked for 10 minutes. It was halted for, not 10 minutes, 10 seconds because that order had wiped out the bid stack. Well, guess what I'd written about 2 years ago on July 19th, 2015, there'd been a similar order in gold that had actually caused two halts because it had jammed price down something like $50 in a matter of, seconds. It's the same old thing. You write this terrible article and then there's a flash crash a couple days later. And then here's this thing, this article that I saw was written on the 30th. I'm not saying the two are connected, but this is how these markets operate. As long as we're trading paper derivatives that can be created from thin air and they are meant to represent the actual physical metal, well, then this, the scam continues, and it's just what we're stuck with.
We've been seeing this go on for a very long time, where they're continually suppressing gold and silver, and it seems like they don't want this to move up. I mean, I interviewed you back, I think it's March of this year, and the gold price and the silver price still very similar to where it was back then. Hasn't really changed that much. I mean, what are they so afraid of with gold and silver? Are they that? I mean, to me, when someone keeps something suppressed like this and someone continually, writes articles, like you say, against something, they're nervous and afraid, and they don't want people looking at it. They don't want people noticing it. And this is what I'm seeing. I'm seeing that they don't want people looking in this direction.
Yeah, Dave, there's two answers to that, Dave. One on a broad sense. Why has gold been managed and manipulated going back to the 1950s, right? And the London gold pool was all part of that in the 1960s. Anybody can Google that. That's a real thing. That was physical suppression of price. That was these 8 countries banding together to supply physical anytime the price moved away from 35 and push the price back down. And then the obvious, once it came back down, they could buy it back, and they tried to keep everything stable. And in a sense, that's what we're seeing now. I mean, there's a reason why, from a larger economic picture, why you would want gold to be stable, right? It promotes confidence in the currency. Everybody, if gold was soaring to 2,000 and 3,000, everybody would be like, wow, what's going, this is a bad sign for, you can imagine the headlines. Yep. So you have that in a larger sense. I also think too that the banks, the bullion banks, the ones that are in charge of physical delivery primarily through London, but then they impact the paper price and they make a market, and they're the ones that create the derivatives in the first place and sell them to the speculators. I think they now have an interest in a very stable price as well, because again, gold is one of those goods where because of sentiment, a rising price fuels physical demand. Very few people, even on my side at this point, are still in that mindset of, hey, keep smashing it because I want to keep buying at a lower and lower price. I mean, everybody wants to see it go up, right? And it's when it goes up that interest returns to the sector and everything goes up, whether it's the metals or the miners or whatever, like we saw in the first half of last year. And so the banks, if they're short, have an interest in keeping price under control just to rein in sentiment and keep, as long as price stays down, then physical demand stays down, and it allows them to perpetuate this system, because what ultimately will break it is physical demand that draws metal away from their hyper leveraged system and makes it impossible to support. Finally, though, Dave, I think I've got a handle on this now, more so than I ever used to, and I think very few people have figured this out. And I think you and I have talked about this before: is this relationship between the price of COMEX gold and the dollar yen, the forex pair of the dollar yen. We probably talked about that the last time I was on, right?
Yes.
Okay, and I think I finally figured out why this is happening, and again, this is just a theory on my part. I don't even know if the banks you see these events like last Thursday night that was odd, and that could have been a bank trader. That could have been an algo run wild. Again, we don't know. I'm not even sure anymore that the banks are in there overtly managing the price and the chart as they were when I first got started, and where I grew a claim and why I have a site in the first place is I recognized this, and you could take trading signals basically anticipating what the banks are going to do, because the banks are in charge. And if you understood that and recognized that, then you could profit from it, which is why I have a site in the first place. But I think now I'm not so sure the banks and their traders are in there actively every day. And just as you've seen the pictures of, UBS's trading floor in Connecticut that, used to be a whole football field full of guys at their computers. And now, there's shit dangling from the ceiling and there's nobody left, right? Because it's all done by computer. I think the manipulation is done by computer now, and it's through that dollar yen. I think and again, this is just my theory, but anybody can plot where you take the dollar yen, which is always quoted, that, what you see on CNBC and Bloomberg, and it's 113 this morning. And you don't plot the dollar yen with gold, you invert it and make it the yen dollar. And you plot a chart of the yen dollar. And if you overlay it with gold on a 1 day, 1 week, 1 month, 1 year, go back 7 years, you see there's a clear correlation. And it really kicked in about 2012. And again, I'm finally getting to my theory, Dave. What I think is, these banks, again, they are the ones on the hook for managing the price, managing the physical supply at the wholesale level around the globe. And they are the ones then that issue, like I said, the derivative contracts. They're the ones that issue the open interest on the COMEX as market makers. Well, they're taking tremendous risk in doing that. JP Morgan had really almost an extinction level event in 2011 because they were massively short, but they have no physical silver behind it. And that last $10 of short squeeze in the month of April was primarily them getting squeezed from 38 to 48. And then, we can talk about everything that happened after that. So what the banks then have done, because they recognize this risk, I think they have to hedge that risk, obviously, right? The delta hedging, they call that. They want to eliminate that risk one way or the other by, but in the gold market, though the global gold market is huge, to lay off your risk of being short by only using the gold market itself, I don't think that pool is deep enough. And so it seems to me, and again, this is my working theory, that the bullion banks have written these algorithms and they have employed them in the digital gold market where they have linked gold price with the dollar yen. Again, anybody listening to this can pull it up on a daily basis and see them moving on a tick for tick basis. And the reason they've done this is if you can, by computer, essentially turn gold into the dollar yen and vice versa as they trade, well then, if it's 1 for 1, you can now hedge your gold exposure, your short gold exposure, through the yen. And the global forex market is a $5-6 trillion a day market. So this is almost an infinitely deep pool where you can cover and hide your tracks and all your hedges. And so putting this all back together of the story of the manipulation, I think the thing's now just on a stranglehold. You mentioned, price hasn't moved much in the last 6 months or whatever it's been. Well, it's because it's so closely linked to the dollar yen. The dollar yen goes up a point, gold goes down $10. Dollar yen goes down a point, gold goes up $10. You go back to last summer, gold was $13.80. Where was the dollar yen? It was barely above 100. You go back to last December, gold's down at $11.60. Where was the dollar yen? 118. And now here we are, it's back to 113 and gold's 12.20. There's such a lockdown stranglehold on the gold price to where fundamentals don't matter, physical supply, all that stuff that people write about as if it has some impact on a daily basis. It doesn't. What moves the global price in these futures markets is simply, in large part, changes to this one pair. And I think that's because the banks themselves have devised this system, linking the two together to help them manage their risk.
Well, do you think that we're ever going to reach a point where we reach an inflection point where, okay, this system just breaks, or is this just going to continue on forever?
Yeah, well, that's the key, right? Because the system has to have some element of physical delivery behind it, right? I mean, it has to have some. You have to be able to physically deliver, not through the COMEX. That's all a scam. Delivery, it's warehouse receipts and warrants, and the banks just kind of circle jerk, passing back and forth to each other every other month. I'm talking about in London, in Hong Kong or whatever. There has to be this price that is accepted by two sides of a physical transaction, and that price is determined largely through all this derivative trading. There has to be physical exchange at that price. And there has to be physical then backing it by the banks. the banks just lever and lever and lever and create these derivatives. And you watch in the specific part of the COMEX where this happens, you can watch the open interest grow and contract based upon how banks are trying to manage this price. The key to ending all of this then is a removal of the physical metal from the banker's hands. I mean, they can lever it more. They can lever it more. Maybe they can run the leverage, from 100 ounces of paper to 1 ounce of physical. Maybe they can run it to 200. Maybe they can run it to 300. But at the end of the day, it's a confidence scheme. This whole mess of synthetic gold that's out there. And if somebody begins to be told, I'm sorry, I know it says here you can have your gold in a week, but it's going to take 6 months. What? As soon as that begins to happen and there becomes a run on whatever physical gold is left, that will finally break the shackles of the system. But I'm not going to, man, I learned a long time ago to sit there and say, oh, yeah, the COMEX is going to fail next month. That kind of thing. I'm not going to play that game. I know, though, that this system can't continue forever because there's only a finite amount of gold and it's being sucked up by the Chinese and the Russians and the Indians and smart people globally. And it's all leaving this closed loop of a banker system that's been in place really since 1975. And so picking when that ends, like I said, kind of a fool's errand, but I'm confident that it's going to. And again, if I might just continue for a second, what this system has done, go back to what we talked about earlier about the London gold pool. At the end of Bretton Woods, right, price was fixed at $35 an ounce, and the U.S. dollar was as good as gold. You could bring 35 of them to the U.S. and exchange $35 for an ounce of gold, right? And that made the dollar the global gold standard, if you will. Well, as World War II and the Marshall Plan and everything was rebuilt, all of a sudden, these countries start to that have been transacting in the dollar as a reserve currency, build up dollar reserves. And they start saying, you know what, I think I'll take you up on that. I think that's a pretty good idea. I'll give you some of these dollars and you can give me some of your gold, US. And by 1957, there were these huge hearings, very important, scandalous hearings almost on Capitol Hill in 57 and 58, because the US's gold hoard had fallen by nearly a third from what we had at the end of World War II, because all of these countries were starting to exchange. So anyway, the U.S. said, well, screw that. We're not going to do this alone anymore. We need some help. And that's what the London gold pool was. The U.S. put up about, I can't remember, 25% of the gold for the pool, and the other 7 countries put up the other 75%. And it was a way of, again, managing that peg of $35 through the occasional pushing gold out into the market and then, having enough supply that it pushes price back down. And anyway, that worked until 1968. Well, where the bankers finally got smart is they started doing alchemy, real alchemy, and substituted these paper promises for the real thing. And so now everybody in the world accepts the GLD. They accept a futures contract. They accept an unallocated account at UBS or, the Perth Mint or whatever, as real gold. And so what you end up with is, instead of this finite amount of real gold that was maintaining a stable price in the 50s and the 60s, now you have this almost infinite amount of synthetic, fake digital gold that is fed into and out of the market to maintain a stable price. But the underlying part of it, the actual physical gold, is still scarce. And so the basic economics of it for someone that's stacking metal for, capital gain, is this recognition that at some point, all of that synthetic gold, people realize, wait a second, this isn't the real thing. I thought it was the real thing. I served as an exposure, but I do want the real thing. And that's when the whole thing finally collapses.
When we look at this, and you're talking about the physical market, the paper market, I mean, the only way that this whole thing is going to fall apart, and like you were saying, is when people ask for physical delivery. I mean, let's just take a look at the economy right now, and let's put this whole thing into perspective. I mean, for the last 8 years, I mean, GDP numbers have been absolutely terrible, and we know that's manipulated. I mean, going from 2008, and you look at the retail brick and mortar stores, they were better in 2008, 2009, 2010 compared to 20, 2015, 2016, 2017. Now we're having huge bankruptcies. Stores are going out of business. And going back to 2008, they started the housing bubble up once again. We know the job numbers are completely manipulated. We know there's no manufacturing here. And they convinced us that we're no longer a manufacturing country, we're a service country. Well, now if all the retail stores are closing and the restaurant performance index is dropping and restaurants aren't doing that well, what are we now? So when I look at the economy, I see that from 2008 to now, it is deteriorated, not in the manipulated numbers, not the stock market, not those things, but the real, nuts and bolts of the economy. It has deteriorated very, very much up until this point. And from what I'm looking at, once this starts to really break apart and it continues to go down this path, this is when all of a sudden people are going to say, you know something, maybe I should get my gold. Maybe I should get my silver.
Yeah. And Dave, you're right. And it's unsustainable. That's the main thing. They've been able to sustain it thus far, maybe past the point where we thought it's unsustainable. If you'd have thought maybe $20 trillion for a notional national debt was as far as it could go, and here we are. I don't know what the number is where it finally collapses, but it begins to go so exponentially upward that eventually it is totally. I mean, Mother said that herself. She's testifying with her Humphrey Hawkins testimony today, and even she said, I mean, the level of this debt growth is unsustainable. It can't, but it's going to. I mean, she can talk about all she wants, but it's going to, and the Fed eventually is going to have to monetize that, and then we always run the risk of what I think has happened. These dollar creditor nations like China and Russia, India, the BRICS, whatever, have recognized after 2008 that this system isn't sustainable. And so they are building their own system outside of it, the whole one road, one belt, Silk Road project, and maybe a currency eventually that will go with it outside of the US dollar. And China's building all these exchanges. They're building all these contracts to be able to price energy and gold and everything else in yuan rather than dollars. I mean, all of this foundation is being laid. And so you're right. At some point, this will probably move rather quickly. I mean, I'm not like talking like in days or hours, but you'll really see this exponential increase in the clear, appearance, notion, whatever, that this is all really starting to crumble. And what you don't want to be is the last person in line. You don't want to be the guy on the roof, with the sign saying, help me, when you knew the hurricane was coming and you had a chance to bug out and, get out of New Orleans, right? And the people that are, that you don't want to be, and again, this helps all of us if everybody were to show up and do this now, but what you don't want to be is the last guy at the bullion bank. You don't want to be the last guy with the unallocated account. You don't want to be the last guy that thinks he owns GLD and it has, this is my gold. I say, yes, I am fully hedged. I have a 10% position in GLD. What does that mean? That doesn't mean jack. And so the time to own physical and to get your hands on it so that nobody else's hands on it, it's actually now. You don't want to wait. You don't want to wait, because that moment, that collapse of confidence is still definitely coming. And as it relates specifically to gold, these banks, these bullion banks that we keep talking about, that are responsible for the wholesale delivery, the wholesale functioning of that market, I mean, they live hand to mouth. I mean, they are the ones that, it's a just-in-time delivery system. All you got to do is kind of, start talking to some of the right people, and they'll still tell you. I mean, the amount of gold that's flowing out of New York and out of London and going into Switzerland and then being recast into kilo bars and shipped out. You can see the export numbers yourself. The same thing's happening in silver too. Once it's gone, and that's when this all begins. And this time is when people should be making sure they're laying their hands on their own physical metal, so it is theirs and nobody else's. Because if you're too late, you'll be too late.
Have you given it any thought of, once this starts to happen where the manipulation, is ending or it's about to end? Many people are trying to look at this and say, okay, if gold goes up, $10 or $20, are you looking at any signs or anything to tell you that, okay, something is definitely breaking down right now, and this is if you don't get in now, that's it?
Yeah, that's a really difficult question. You can pick off any one of a number of things, whether it's a global market meltdown and a financial collapse like we saw in 2008, Or maybe it's something as simple as watching the spot price of gold versus the COMEX price. You know, if the actual spot price where people are allegedly transacting physical moves to where it's, backwardated versus the futures chart, or the futures chart gets fully backwardated, where all of a sudden the front month is trading well in excess of what the further month out contracts are. Maybe it's a sign like that. I think also we're going to want to watch some of these other exchanges. We all got excited a little over a year ago when the Shanghai Gold Exchange started that yuan fix, right? Twice daily fix in yuan. That's never been, it's never gotten too out of whack with London. I mean, there's that great Did the System Collapse website that kind of shows you that in real time. You ever start to see that really get out of whack? And I'm not talking like $10 an ounce, but like $30, $40, $50 an ounce. That might be noteworthy. But for now, it could very well be something that sneaks up on you pretty quick. And in the end, over maybe a course of a couple of days, the COMEX just kind of cash settles everybody as quietly as they can, all the existing contracts, and then price is now discovered someplace else on a more physical basis. And again, what you don't want to be is the last person in line. If you've got one of these accounts, and there's probably not a lot of people listening to us that do, but folks that do have unallocated gold, or maybe they took delivery of remember back like in the MF Global days, there were people I had people writing me that had delivery, certain warehouse receipts in their MF Global account for 5,000 ounces of silver. And they thought they had silver, and come to find out, no, and it just went poof, just as did their cash when MF Global went tits up. And so any form of that isn't in your own personal safe, in your sock drawer, whatever it is, it ain't yours. I mean, somebody else is going to claim it before you do. And you just don't want to dilly-dally. If you're in this to win it, you don't want to be dilly-dallying and thinking, I can always get my note. And when it all ends, that's not going to be the case.
Now, the central banks, I mean, we're talking about the economy, we're talking about gold and silver, and the Fed is out there talking about rate hikes and things like that. And, they're saying they don't think they're going to do more rate hikes. But there are central banks around the world where, like Canada, they're raising their rates. Central banks are looking to tighten. They're looking to cut stimulus. When they do all of this, I mean, because since 2008, this entire economy has been sustained on stimulus. It's like a drug addict, who's been taking drugs. Now we're coming off the drugs. What do you see happening with all of this talk and everything that's happening here?
Well, the most interesting aspect of it, Dave, is to watch this in real time. One of the big themes put out by the investment banks this year was that the bond market bubble was finally going to bust, right? That all this money that's gone into bonds, and the Fed was going to be raising short rates, which was, of course, going to make long rates go up too. And instead, that's not what has happened. I mean, let's see, Mother's now raised the Fed funds rate 3 times since December the 1st. The first one was in December 15, but she raised it in December, March, and again in June. That's 75 basis points. They've raised the shortest rate, the overnight rate, the Fed funds rate, the only one that they have direct control over. And the long rates have actually gone down. The 30-year long bond double topped at 3.21%. And now today it's 2.9? So all they're doing is flattening the yield curve, and they can't seem to figure out why. Well, these global central banks, whether it's the Fed or the ECB or the Bank of Japan, they printed so much freaking cash and given all of it basically to their banks that cash is all now floating around out there, always looking for a place to go. And so it creates almost like a put under the bond market. There's like a constant bid for bonds, at least on the long end, because everybody's desperately searching for yield. And so you get these things where, like after the last FOMC, and again today during her Humphrey Hawkins testimony, Mother's talking about, we're going to start to reduce the balance sheet. Well, okay, good for you. And they're talking $10 billion a month or something. I mean, they've got, $1.5 trillion in treasuries, and she's going to start dumping $10 billion a month. Big deal. But what she's attempting to do is jawbone and to frighten that bid for treasuries, for sovereign debt all around the world, trying to frighten it. Well, if we're going to come in with all this $10 billion of fresh supply to the market every month where we're selling off our portfolio, well, then maybe you should wait. You shouldn't be bidding for bonds now. Maybe we can get the long end to go up so that we do keep a positively sloping yield curve, because all they've done is jack the short rate while long rates have fallen. They flatten the yield curve. Anybody that took Econ 101 in college probably remembers a flat yield curve is almost always a precursor to recession. That's exactly what, after 17 rate hikes in a row, from 2004 to 2007, Greenspan, I guess, or Bernanke, whoever it was back in, I guess, with Bernanke, inverted the yield curve. And that was all part of what eventually brought upon that financial collapse. Well, that's what they're doing again now. So when Mother all of a sudden today is like, well, maybe we won't raise short rates in the near future. Well, no shit. I wonder why. Because if you keep going, all this talk about, how about 6 more rate hikes and we're going to put Fed funds at 3%. Oh, okay, so Fed funds are going to be 3% while the 10-year note is 2%? That won't hunt. And so this whole thing is still in a pretty big state of flux. And what if we do get a big slowdown? What if we do get a market crash? The QE4 would seem to be right around the corner. So I will see what happens economically. I would say it's not as much of a layup as all these banks and analysts would have you believe, that that rates are just going to keep going higher and that the Fed is in control. I'd say it's probably a little more, dicey than they would have you believe.
Yeah, I would think that the Fed is trying to keep control and trying to control the economy, but I don't think they actually really have full control, because it's always that black swan that, we miss this, we miss that brings down the entire system.
And Dave, I'm sorry to interrupt you, but here's just a real basic thing that anybody that's been in the markets, or just an investor trader that's been paying attention for more than the last year, here's a real basic little point that most everybody can recognize. I mean, I mentioned jokingly earlier that I've been at this for, I got a license 27 freaking years ago, and I've been paying attention ever since. You didn't know. I mean, every once in a while, Greenspan would show up with his briefcase. Remember that? And Greenspan was the only guy that you knew. Yes. You knew Greenspan was the head of the Fed, and that was it. And then even when Bernanke was around, Bernanke'd show up for these Humphrey Hawkins testimony. They beat the crap out of gold, and every once in a while he'd give a speech and that kind of stuff. But nobody knew anything about the Fed. And now, we could probably sit here, just you and I, and rattle off what? 2/3 of the voting members of the FOMC just by memory.
Yes.
Because these people are out on a daily basis giving speeches, and they're treated like rock stars. Just that point alone should kind of illustrate the desperation of these central banks to create and maintain this kind of vision, this feeling of normalcy, that they are in control. I mean, that alone should kind of betray that it's not normal, that things aren't just fine, that things are being held together, with the proverbial chewing gum and baling wire. And then that continues. You see this now, again, on a daily basis.
Yeah, that is true. And, the one thing that the Fed is not able to do, and this has to do with the real economy, where, they can control the stock market. They can have their little computer programs and make it go up and down. They can control the gold and silver with, like you said, their algorithms and things like that. The problem is there are actual people in the economy where they want people to spend money. They want people to put money into the economy. And when people don't have jobs, people are losing jobs, people don't feel secure in their livelihood, they don't go out and spend. And this is one thing the Fed was never able to accomplish, where they said, okay, everyone, start spending your money. And this is a problem for them. And this is why we see retail, completely imploding on itself.
And you talk about jobs and all this stuff. And one of the big things that nobody ever seems to want to talk about is the state of healthcare here, at least specifically in the U.S., and the amount of available cash and capital that is sucking up, and it's crushing small business. I mean, I'm a small businessman, as are you. Mrs. Ferguson is a homemaker and busy running. So it's my business. And I've got to provide the healthcare policy for my family. When I first started doing this, and first left the corporate train, had to get my own insurance for my family. I got it through Humana. It was about, I can go back and look at my records. It was $387 a month. Over time, it went to $500, and then it went to $700, and then Humana exited the state that I live in, left only one provider. Cost immediately went to $1,400 a month last year. This year, it's almost $1,800 a month. And I just got a letter a week ago that now Blue Cross Blue Shield is also leaving my state, leaving 0 providers, which I guess if I don't find some kind of option, I'm going to have to self-insure. Regardless of that, we'll worry about that in the months ahead. $1,800 a freaking month, Dave, that I could be spending. I could hire somebody for that to help me as a webmaster. I could be spending $800 a month with a PR firm and that employs somebody. I get but no, I'm just flushing it down the toilet for health insurance. So besides the fact that cost, you've got how prohibitive is that? If it's prohibitive for me, how prohibitive is that for anybody else that wants to start a business? And you always hear these stats about, small businesses. That's where the employment growth is, right?
That's right. Yes.
Entire system is an absolute disaster, and it's not fixable. It's not fixable. And I don't mean the healthcare system. I'm talking the entire, what we've done from a Keynesian standpoint and all this debt. And it's all, metastasizing and showing itself in all these different places. And all of that is why there's 95 million people unemployed, out of the workforce. All of that. It all fits together. That's why there's no economic recovery. That's a large part why there's no inflation, because nobody has money to buy anything. All of these pieces fit together, and it's not a fixable. It's just not a fixable thing, and that's why we have to continue to pay attention, prepare for what eventually is going to happen. And again, as we've discussed, acquisition of physical metal is all part of that.
Craig, thank you very much for being on the X22 Report Spotlight. I really appreciate it. Once again, how can people see your work?
TF used to have the moniker Turd Ferguson, so tfmetalsreport.com is we'll call it a vibrant online community of people that we all see this the same way. We all see what's coming, no doubt about it. On a daily basis, we're talking about, the daily movements of gold and silver, but we're also preparing for the end of what we call the Great Keynesian Experiment. So I encourage people to check it out. It's a great site full of great people, tfmetalsreport.com.
Craig, once again, thank you very much for being on the Spotlight. I really appreciate it.
Always a pleasure, Dave. Thanks for the invite.
Thank you.